Today, the Federal Open Market Committee decided to raise the target range for the federal funds rate by 1/4 percentage point, bringing it to 1/2 to 3/4%. In doing so, my colleagues and I are recognizing the considerable progress the economy has made toward our dual objectives of maximum employment and price stability. Over the past year, 2.25 million net new jobs have been created, unemployment has fallen further, and inflation has moved closer to our longer-run goal of 2%. We expect the economy will continue to perform well, with the job market strengthening further and inflation rising to 2% over the next couple of years. I'll have more to say about monetary policy shortly, but first I'll review recent economic developments and the outlook. Economic growth has picked up since the middle of the year. Household spending continues to rise at a moderate pace, supported by income gains and by relatively high levels of consumer sentiment and wealth. Business investment, however, remains soft, despite some stabilization in the energy sector. Overall, we expect the economy will expand at a moderate pace over the next few years. Job gains averaged nearly 180,000 per month over the past 3 months, maintaining the solid pace that we've seen since the beginning of the year. Over the past 7 years, since the depths of the Great Recession, more than 15 million jobs have been added to the U.S. economy. The unemployment rate fell to 4.6% in November, the lowest level since 2007, prior to the recession. Broader measures of labor market slack have also moved lower, and participation in the labor force has been little changed on net for about 2 years now, a further sign of improved conditions in the labor market, given the underlying downward trend in participation, stemming largely from the aging of the U.S. population. Looking ahead, we expect that job conditions will strengthen somewhat further. Turning to inflation, the 12-month change in the price index for personal consumption expenditures was nearly 1.5% in October, still short of our 2% objective, but up more than a percentage point from a year earlier. Core inflation, which excludes energy and food prices that tend to be more volatile than other prices, has risen to 1.75%. As the transitory influences of earlier declines in energy prices and prices of imports continue to fade, and as the job market strengthens further, we expect overall inflation to rise to 2% over the next couple of years. Our inflation outlook rests importantly on our judgment that longer-run inflation expectations remain reasonably well anchored. Market-based measures of inflation compensation have moved up considerably, but are still low. Survey-based measures of longer-run inflation expectations are, on balance, little changed. Of course, we remain committed to our 2% inflation objective and will continue to carefully monitor actual and expected progress toward this goal.